Well, David, Fed Chair Jay Powell reiterating that inflation has increased notably in recent months, but does remain transitory.
In terms of overcorrecting, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. The effect on inflation will be neither particularly large nor persistent. And part of it just is that we've been living in a world of strong disinflationary pressures around the world. Jay Powell won't try to destroy the economy in order to save it, because he already tried that once in 2018, and it was wrong, and he learned from his mistakes. Scott, as a sort of let's say our base case, because I know we're into year-end dynamics and everything is unpredictable, especially COVID, I think the rally we're seeing has a lot of fuel.
How long should Americans expect to face higher prices?
The inflation has everything to do with the supply chain. However, we have the tools to deal with that. We remain strongly committed to inflation expectations anchored at 2%, and we'll use our tools as appropriate to achieve that.
Thank you. Boston Fed President Eric Rosengren announcing individually here that he will sell all the individual stocks he owns by September 30th.
So 7.5%, and that is, of course, on headline year over year. As expected, it's 7.9% for year over year inflation.
To use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
The Fed make a mistake and tighten too much. Well, I hate to say it, the Fed had already made the mistake when they kept the liquidity, the liquidity spigots open at emergency levels.
This economy cannot support higher rates quickly.
Putin began amassing troops along the border. Make no mistake, inflation is largely the fault of Putin.
Ugly close, down 3% on the S&P, the Nasdaq down 3.6%. It was pretty bad all day.
I don't want you to show up and now tell me, oh, don't worry, everything's great, because you've been more rosy than a lot of other people.
How's it going, everyone? Mario here. It's been a while since we did some market commentary. Last few weeks, markets were pushing higher with the Powell's 50 basis points optimism. Suddenly, this week, something happened which spooked the markets and turned the sentiment from risk on to risk off. Let's analyze what it is one after the other. Last week, we got the payrolls data. The payrolls data showed that the economy has added more jobs than the cooks have forecasted. They delivered a good report for us, so these idiots can brag about how much jobs that's been added into the economy. But is it true? Is the report really good? One thing to note about these employment data is that they have always been a lagging indicator in the economy. But reading into the report, there was a wide divergence within the sectors where people are getting and losing jobs. The report, the leisure and hospitality, healthcare, government, social assistance, construction, information, financial activities all added more jobs, while the sectors of retail, trade, transportation and warehousing went down big time. One of the major reasons which spooked the market is not the jobs that's been added, but it's in the wage inflation side of things. Some of these idiot CEOs and idiot fund managers have been writing love letters to Powell recently, begging him to please don't increase the interest rates, please don't do it, our stocks are going down. But if God forbid they have to pay more to their employees, that's where they draw the line. Anyway, the wage inflation is spiraling out of control, which means the amount of money that's been paid through the employees on an hourly basis went higher, even though the amount of hours worked by the employees went lower. I know what you're thinking. Hey Mario, why are you bitching about employees getting paid higher? What are you, an asshole? Let me finish, hear me out. Wage price spiral is one of the major concerns when it comes to economy. It put a test to the pricing powers of the company, which in turn affects the earnings report and the money made by these companies. There is a reason why the companies only with the proper standard pricing powers survive an economy like this. Anyone who runs a business can understand what I'm talking about. A lot of people who runs a business would have fired some of their employees because it's eating away into their profit margin. So how does it impact the markets? The market had a huge gap down on Friday but recovered almost all the losses, but continued to sell off through Monday, Tuesday and Wednesday. This is where the things got interesting, because with the strong economic data, it pushes the Fed to keep rising interest rates, takes away the pivot bullshit optimism away from the traders. Well, this is where the problem arises. The miscommunication from the Federal Reserve side. 2 days back, before we got the payrolls data, Powell was so confident that the inflation is coming lower and the inflation expectations are lower, and well, they might as well go with the 50 basis points. Well, fuck it, they'll go with 0 basis point. It doesn't matter, inflation defeated. Market took what it wants to hear and it just kept on going. And then it got a reality check saying that the job markets are not slowing down. Well, the inflation expectations did go down, but we got the PPI like on Friday and it still showed a hotter than expected reading. Well, this miscommunication causes volatility in the markets. The Federal Reserve been doing this back and forth dance, not communicating well with the investors, which is causing a whipsaw in the markets. Now with the economy slowing down and the Fed keeps raising interest rates, it's going to push us into a recession. It's funny how we came from soft landing to not so soft landing to like recession is now the base case. The problem right now is with the yields pummeling down like this, it doesn't matter what the Fed does, their hands are tied at this point as the bond markets are doing their job for them, just like always. We had a massive inflows into TLT, which is the long-term treasury bonds this week. Precious metals like gold and silver had a beautiful week. Listen to what the market is telling you. It's telling you that the inflow is into the precious metal and TLT while they're selling out on dollar and yields. In previous recessions, the outperformance were the bonds and the precious metals as the dollars crashed, yields crashed, expecting an intervention from the Federal Reserve. But the problem here is the Federal Reserve is not going to intervene to come and save our asses. They have been very clear on one thing. Their main goal is to bring down the inflation to their target level at 2%. Until that happens, they are not going to stop reducing the interest rates. So now that brings up the question, is the yields already topped? Is the dollar already topped? If the Federal Reserve keeps raising interest rates, and if they see the inflation going up higher, the market will start pricing in even more aggressive rate hikes. They will start pricing in 75 basis points instead of the 50 which has been baked in at the moment, which will cause the yields to push up again, which will cause the dollar to push up again. If you're one amongst them who are expecting a Fed to pivot, well, I don't think it's going to happen anytime soon. Even though I spoke about the miscommunication from the Fed's part, the only thing which they were clear on is that they are not going to reduce the interest rates as long as they see the target inflation comes back down to 2%. The next week is going to be one of the most important weeks for the markets. We have the CPI data, we are going to get the retail sales, we got the FOMC on Wednesday, and we got Mr. Powell himself giving out the press conference to this dumbass journalist who doesn't know what questions to ask him. Well, we have a beautiful week ahead. They're going to whipsaw us around back and forth. So let's get into the CPI and what to expect from it. I've been having conversations with a bunch of restaurant owners lately. One common thing I hear from them is the prices are still pushing higher. They don't see any improvement from their side. This is just one factor, of course, so they can't make a case that the entire CPI is going to be up just because the food side is still pushing to the upside. But this is something to keep an eye out for. Now, if we do get a hotter than expected CPI, will that push the yields up at least for now because the Fed needs to keep raising the interest rates? Or is it going to push the yields even lower because it says the Fed needs to be more aggressive in an already weaker economy? We will go over different scenarios. What might happen on Wednesday after we got the CPI? What might be the reaction of the Fed? So this might be the scenario 1. Reduce the rate hikes now ahead of the time because the inflation expectations are lower. If the Fed takes this risk and start reducing the rate hikes here and inflation comes lower gradually in the rest of 2023, well, this might work. So doing this can be really dangerous because the risk of us getting another hotter than expected CPI and the inflation changing its trajectory to the upside again can impose a catastrophic impacts on the economy. If you go back and take a look at what happened at 1970s to 1980s, Federal Reserve did the same mistake of like hiking the interest rates, lowering it again, only to hike it again. The back and forth can have a catastrophic impact to the stock market as well as the economy in itself. The 1970s to 1980s had the worst stagflationary environment, and the stock market returns were close to nothing for the period of 10 to 15 years. And I don't think Federal Reserve is going to do the same mistake again, but knowing Powell, I won't rule it out completely. Now, the scenario 2. Increase the rate hikes aggressively now and then lower it later as the data actually shows that the inflation is going lower. Powell wants to keep raising interest rates until the inflation gets back to their neutral level at 2%. According to him, better be aggressive now and reduce it later or cut it later once the inflation comes back to their neutral level. Well, this has its drawdown as well. It can push the economy into a recession. A lot of people might lose jobs because they didn't raise the interest rates when they had to, but they're already back. They're way behind the curve right now. But this is the only way. They have to do it right now because the price stability is one of the major concerns. People are freaking out right now because their company stock prices are going lower. Well, you can see people like Elon Musk, Cathy Woods, they are against this strategy because their stocks are down like 50 to 60% and year to date alone. The funny thing about this is you don't see these people complaining when they kept their interest rates at zero for so long because, hey, my stock is doing good. That's all I care about. But now, well, they had to bring the inflation down because it's affecting the normal, regular, middle class folks. But hey, why the fuck will we care about all that? All we care about is our stock price, is it? Well, the recession is the best case scenario here. No soft landing. Probability wise, it's very less in order for us to go through 2023 without any recession. So the conclusion is, when morons who hold high responsibilities fuck up, it's not them who's going to suffer. It's the regular people like you and me who's going to feel the heat. Well, with that being said, let's move on to the technical analysis of SPY and QQQ and see what to expect leading into this week. Looking at the daily charts of SPY, the range so far was 390 to 402.80. They broke above it after the Powell shenanigans happened and marched all the way up to 410 before getting rejected onto that downward sloping trend line coming all the way from the all-time highs. Now, in a normal garden variety markets, it's pretty normal to expect an opposite reaction from this trend line. But if bulls were actually in control, they should have held on to this 402.60 area as support. But after the phony jobs data, they exactly did that. They bounced off from this level only to get rejected at the trend line again. Now, at the weekly close, they not only lose that 402.60 zone, but also lost the lows of 493.48, which was the lows before that Powell push happened. Leading into this week, based upon the close on Friday, there is a decent probability to see SPY capping down to run a test to 391.99 and 390 down south. If they lose 390, watch out. The AVWAP from the lows of 340 is currently sitting at around 385 and change. We might see 385 being tested. We might see some buyers sitting around over there at that spot, and that might be an area to expect SPY to offer a temporary bounce all the way to 390 again. But breaking or closing candles under this 385 zones open doors for that gap to be filled all the way down to 380, as you can see in the daily charts. If they break under 380, we will handle it on a real-time basis. As a trader, we got to be aware and be prepared for both kinds of scenarios. So let's play the devil's advocate and talk about what happens if they hold on to 390 to 391.99 and start to bounce to the upside. Well, the first level of resistance the bulls will face is at around 393.49 zone. Closing candles above opens doors for bulls to run a test again to this 395.77, and if they take it, they might likely spike it through that 397 zone. Anything above 397, we will take it on a real-time basis as well. But as long as the price is under 393.48, bears have the total advantage here to take the price down to 390 or even under it. If you need real-time updates as the session is unfolding, go ahead, check out the Patreon. It doesn't matter if you're a scalper, it doesn't matter if you're a day trader or working for 9 to 5. I got something for each and every one of you. Go ahead, check it out. Link is down below in the description. That being said, it'll be a tough market to trade this week. Manage the risk wisely. Take high probability trades. I'll see you guys in the next one.